The fundamental assumption of SaaS is it's hard to change somebody's mind because people don't change their mind frequently. But once they change their mind, they'll stick with whatever the new decision is. So that is a way of saying, I can convince you to try my product, but it's going to be expensive, high customer acquisition cost.
Welcome to Revenue Insights. We're joined by revenue leaders from some of the highest growth companies. Together, we explore how they built their revenue teams, the journeys they've been on, and the lessons they've learned along the way. Revenue Insights is brought to you by Ebsta. We're an AI-first revenue intelligence platform designed to help you close more deals, retain more customers, and forecast better. Enjoy the podcast.
Hello, everybody. On today's episode of the Revenue Insights podcast, I'm thrilled to have Sam Jacobs with us. Sam is the founder and CEO of Pavilion, the world's leading community for go-to-market leaders in B2B tech. Pavilion has become the platform where over 10,000 executives come together to connect, learn, and grow. Sam is also the co-host of the Top Line podcast and the author of the best-selling book, Kind Folks Finished First, which explores the role of kindness in building successful businesses. Sam, I'm delighted to say welcome to the show.
Thanks, Guy. I'm delighted to be here.
So before we get started, I think everyone would love to have a little bit of understanding as to your background. And you've got this incredibly diverse career from co-founding Pavilion to writing a best-selling book. But if you can tell us a bit more about kind of what got you here, and most importantly, what really inspired you to build a community like Pavilion?
I've been in startups since really 2003. So what is that? 22 years that I've been working at venture capital-backed high-growth businesses. Before that, I ran a record label. And before that, I was in finance. So you're right. I have had a varied career. But the last 25 or so years, I've been working on high-growth companies, primarily in revenue-generating functions. And, for 15 years, from 2003 to 2018, I was increasingly in leadership positions, and the reality of those leadership positions did not meet my expectations. I thought that life would be stable, that I would work at good companies for extended periods of time, and we would build great things together. And it turned out that my career was much more volatile than I imagined it would be. And my stints kept getting shorter. I worked the first place 7.5 years, the next place 4 years, the next place 2 years, the next place 9 months, and then 10 months. So my career was very uncertain, and partially because the jobs themselves, being a chief revenue officer, chief marketing officer, these jobs have no formal playbooks. The career playbook is dead and the go-to-market playbook is dead. And there wasn't a resource that was relevant and timely and kind of future forward. That wasn't being taught by, a guy that worked at Procter & Gamble 30 years ago, but was really like the modern resource and modern community that I could go to get the answers to the questions I needed. And that's why I started Pavilion. I started it to address that career gap that existed for executives and the next generation of executives, where we just didn't have people that we could ask, talk to. We didn't have the content that we needed. We didn't have the tools that we needed to navigate this new world. And so I started Pavilion to give people those tools and to give people, the right people, to be honest, the right people that want to improve and that want to develop and that want to be great. I wanted to give those people the resources they needed to be great. And that's effectively how we got here. We have chapters all over the world. We have a big chapter in London where you're based, Guy. I'm now based in Barcelona. We've got a great chapter here, 10,000 members. And the purpose of Pavilion is to equip all of these operators with the tools they need to navigate a world that has only become more volatile, more uncertain, and more dangerous in the almost 10 years since I started doing this.
That's fascinating. And it's incredible what you've created in quite a short amount of time, really. When did you really start Pavilion? When did we start to see this growth?
2016, I started it in my spare time as the New York Revenue Collective. Really, the origins of it were the Brooklyn Sales Meetup when I worked at Livestream, which has since been acquired by Vimeo. And I started bringing people together. Funny enough, this was in Bushwick. If you don't know the New York City area, it's sort of like it's a very industrial, far-flung area. It's not in Manhattan, and that's where the Livestream offices were. But lo and behold, two people that were always at our Brooklyn sales meetups were Nicola and Alina Vandenberg, the founders of Chili Piper. And this was when they were first designing the ideas that would become that company. So I started in my spare time as a meetup for people to get together. We then started getting dinner every quarter. We had some very strict membership criteria, which have since been relaxed, which we'll probably reintroduce at different levels of membership in the future. But it was never intended to be anything. The first thing it was intended to be, because I kept getting fired, It was intended to be a place where I could find my next gig. That was the first thing. Mission accomplished. Then I kept getting fired, and so decided, okay, I need some side revenue. I need a side hustle if my career is going to be so bumpy and so up and down. And so I started charging for Pavilion January 1st, 2018, $50 a month to the first 20 people. Amazingly, all 20 of those people are still members, which tells you, maybe I had the right idea about the price point at that time. That was it. It was in New York City, $50 a month. It was a side hustle that would give me a little bit of extra money to please, to please the people in my life. Nudge, nudge, wink, wink. After that, people started reaching out to me from all over the world, including your local chapter head, Tom Glasson. And so then people started saying, could I build a chapter in Boston? Can I build a chapter in London? I said, sure, let's figure out a structure where that will work. I got fired again at the end of 2018. And I said, okay, time to figure out if this thing can be full time, so that at least I have a job I can't be fired from. So job number one, find my next job. Job number two, side hustle. Job number three, a stable career at a company I control so that nobody can fire me. Never intended to be some world-conquering movement, but it resonated. The ideas resonated. The way that operators like you and me feel every day resonated with the audience, with the people out there in the world. They connected with this idea that we're under fire and that we need tools to help us manage and navigate this uncertain world. COVID came. We continued to grow very quickly. Elephant Ventures came early 2021 and invested $25 million, which was a thing I never expected. And the journey since then has been an up and down roller coaster, as it has been for many of us, including you, Guy. And here we are today. Hopefully we're on the ascent again in terms of the journey of Pavilion. But it's been a lot of ups and downs, to be honest.
I've been a member now for nearly 3 years, and what it gives me is a community of my tribe, people similar to me, facing similar challenges to me, and an environment where I can be open and vulnerable with them, and they can be with me. And what's incredible is how much we end up sharing with each other. And as you know, I'm a big fan of this perception of sharpening iron. So you get a bunch of CROs together, they all become better CROs. You get a bunch of CMOs together, they all become better CMOs. And we see that now across the community, whether those are in virtual events or some of the in-person events. I was at a Pavilion breakfast just yesterday, and as you know, I was in Denver with you just last week, where we were celebrating the CRO Summit, which was just probably one of the best events that the Pavilion's put on to date. It really, really was very well received.
Thank you, Guy. Well, how was the breakfast, by the way?
Breakfast was excellent, as always. It was actually run by Nicola. Everyone was out, but she did an incredible job, as always. And the London community is really thriving. Every dinner is sold out, every breakfast is sold out, and everyone's just so keen to share, especially at the moment, because there's so much change going on at the moment. The big takeaway, and Sam, I've used this quote now a couple of times since last week when I heard it from you. We were in the room with maybe 200 CROs, all of which have got decades worth of experience. But the one thing that rung true for all of them is that no one in the room had sold in 2026. No one in the room had sold in 2027. And we know that GTM and go-to-market is broken at the moment, but it's up to us as a community to fix it. And that really inspired me and really something I took away from the session. So perhaps we can share a little bit about what came out of last week's session. I was on stage sharing some of the latest insights from the 2025 benchmark report, which we do with Pavilion. There it is there. I think the biggest takeaway for me is that headline number that just 14% of sellers are now responsible for over 80% of new logo revenue. So if these things are just not sustainable. So what do you think the future of go-to-market looks like?
I care about you, as you know. And my baby daughter was wearing the clothes that you and Dev sent us even just yesterday. So thank you for your kind gift. But I don't know that I agree with the premise. Is go-to-market broken? I don't know that it's broken. I just think it's hard. Maybe it was just too easy for a long time. And maybe we took the wrong lessons from it. That's my takeaway. Listen, I think we can all agree, right? What's the big headline, I think, from the CRO Summit and from what I'm seeing, right? What am I seeing? It's exactly what you said, Guy. A CRO dinner the night before the summit. Everybody raises their hand. Number one challenge, pipeline generation, how to grow, right? Jamin Ball at Altimeter this week said, net new ARR growth in publicly traded SaaS companies is down 30% year over year. GTM efficiency, every dollar that you spend to generate a new dollar of ARR is going in the wrong direction. It's becoming harder and harder to grow. Does that mean things are broken? I think this is the new normal. That's what I think. I don't know. We can call it whatever we want, but there's no use complaining about it. The world is more difficult. At the same time, I don't even know. I could Google it, but Mark Zuckerberg just invested in Scale AI yesterday. Some people say charlatan, but this 28-year-old CEO, Alexander Wang, makes $500 million just yesterday. And we interviewed this guy, Eric Simons, who's the CEO of this company, Bolt.new, which has gone from 0 to 40 million in 5 months. So there's winners and losers out there. And I think the world is very, very difficult. And I think that that's not going to change. I don't think that that's going to change. And it was funny because, Guy, at the same event that we were at, I'm standing next to Irina Novoselsky, the CEO of Hootsuite, and we're just laughing. We're laughing because she said, I wake up in a cold sweat every morning because I am terrified that I'm not navigating this new AI-driven world in the right way. And I certainly feel like that. I don't know if you feel like that, Guy, but things are changing so rapidly. They're telling us capabilities. You then try to test those capabilities. Turns out that sometimes they work and sometimes they don't work. There's a lot of noise. There's a lot of smoke and mirrors. Figuring out signal from that noise is really hard. So that's why we exist. That's why Pavilion exists, to help people navigate this new world and to give us the tools that we need and to help us so that we all figure out the answers together. But, I don't think it's going to change. And I don't know that it's necessarily fixable. The good news is that these companies all want to grow. And the rate of company formation is only increasing. And that's probably good news for salespeople, I would think. We can say, oh, is AI going to replace all SDRs? Maybe. But there are still, I want to meet people in person and do business with them. And I think I'm not the only one.
Oh, I think that's very, very valid. And everyone in the room seems up for the challenge, right? We know that things are changing and they're changing really fast. And I suspect that change is going to accelerate, at least for a period. Having a community around you to be able to actually engage with people and work out what's working and what's not is the quickest way for us all to move forward together.
I agree.
So we've had some questions. Before today's podcast, I posted something on LinkedIn and we had lots of people come back with all sorts of questions for us. So we're going to work through those.
I'm ready.
So Max came up with a really interesting question around AI, was talking about whether we feel that there's AI fatigue now for CROs and CMOs. So with the rise of RevOps and AI tools, are we noticing a shift in what best-in-class go-to-market org looks like? How do we think it's going to impact a company's unit economics? And where do we look for the needle to move to, i.e. on CAC and churn and so on?
Listen, nobody knows the answer to these questions, so I would probably hit it back to you. But so let's both answer this question, Guy. You're a subject matter expert, but here's my answer. My answer is I do not think CAC is going down. I think it is going to continue to go up. Again, we interviewed this guy, Eric Simons, on the Top Line podcast, which I host, which you've been on, where Asad was famously not very hospitable to you, I felt. So I'm sorry for that. But this guy, Eric Simons, says that there's 1 million different web applications that have been built in Bolt over the last 5 months. And what does that say to me? New companies are going to form more rapidly. The cost of building something new has never been cheaper. And there's going to be a tremendous amount of crap. The noise that will flood the airwaves, and you can say there's going to be an AI that screens for you. It'll be, that I think it was Andy Paul that built that company that since shut down, where you had to pay to deliver an email to somebody. I forget what it was called. But my point is, noise will increase because people are building new companies and those people want those companies to grow. And so if noise increases and separating signal from noise is harder than ever, that tells me that customer acquisition cost will go up. So I think CAC is going to go up, and I don't think GTM efficiency is going to move in the right direction. And I think that's why, the way to think about it, in my opinion, is that you're going to need very high operating efficiency to fund higher CAC. What I mean by that is you need the back office to be largely AI driven so that you can fund the humans in the front office. That would be my hot take. Second hot take I have is we'll see, but we talked about it this week on Top Line. Yesterday or 2 days ago, OpenAI released all these native integrations into OpenAI, and one of them is into HubSpot. And so you're going to be able to, well, they say, we'll see if it's true, but imagine a world where you can, in ChatGPT, you can say, what is my win-loss ratio for this ICP versus that ICP? And it'll query HubSpot. I don't know if it'll be able to build a report dynamically, so I feel like it probably won't work quite as well as they sell it to us, which is, another truth of AI. But I do think that the world is changing more rapidly. I think I have AI fatigue, and I think that that's tough poo poo for me, because the world is not slowing down for me. And I have a post going out today. Like, you and me, Guy, we're older at this point, and there's lots of gray in both of our on our and the hair in our bodies. But we're competing with young people, and the rub against young people used to be they didn't want to work. Now the rub is they work too hard. Now the rub is in San Francisco and in places like London, where Manny's building his new company, people are working 12 hours a day, 7 days a week. And so that's who we're competing with. That's the degree of difficulty. So we might have, AI fatigue. That's tough on us, because that is the competition that we're faced with. And I think my takeaway is that things aren't getting easier anytime soon.
I definitely buy into that. And, we started the year thinking that, 2025 was going to be a bumper year for everybody. And of course, then we hit some headwinds that we're not going to get into today. But I think there's a number of things going on here. I agree with you. There's an insane number of point solutions out there around AI, and some of them are almost amazing. And that's the challenge, because they can be very quickly become a distraction. And even when I look at my own sales team here, the number of things that they got that buzzing away, whether it's, alerts on their phone or Slack kicking off or emails coming in, we're already distracted by far too much. I think the disciplined businesses that allow, perhaps a strategic, RevOps function to play around and investigate on some of these interesting new tools coming through, but keep the team focused on what they're there to do, I think will win. We need to find ways of using AI to remove distractions from our sales teams, not add them in. And we saw that in the data. A good quality AI-enabled AE is spending nearly half of their time talking to customers, while the average AEs are spending less than 2 hours a day. So again, finding ways of taking away admin burden, using AI to enhance their day and freeing them up. And the acid test, that the lens we should be looking through is, does this allow my sellers to spend more or less time talking to my customers and prospects? And I think that's absolutely the focus that we need to maintain, because even in 2025, relationships still drive revenue. The churn question is a slightly different one. We now live in a world where we all celebrated SaaS as a beautiful model, as a great way of low cost way of engaging with some really great technology. The challenge with SaaS as a supplier is that every single year, or maybe two if you've got 2-year contracts, your customers have the opportunity to make a big buying decision. While in the past, they'd spend capital on a big project, and then they might pay some maintenance, and that would be that. So the bar was relatively low. If you're not able to articulate your ROI to your customer in a really simple and compelling way, the chances are you're going to have a churn problem. I'm not sure that's a bad thing, but we absolutely need to recognize that the CFO is now involved in every decision, and every decision to retain technology is not just going to be an auto renewal anymore. We need to be in there. We need to be engaging with the C-suite during our QBRs, and we need to be adding real strategic value to our customers. Otherwise, we're all going to suffer with churn.
I agree with everything you said. And I think there's some real fundamental and secular challenges with quote unquote SaaS that impact all of this. So what's my point? There are a few fundamental assumptions. What's the fundamental assumption of SaaS? The fundamental assumption is it's hard to change somebody's mind, because people don't change their mind frequently. But once they change their mind, they'll stick with whatever the new decision is. So that is a way of saying, I can convince you to try my product, but it's going to be expensive, high customer acquisition cost. But once you use my product, I'll bake it into the workflows. It'll be very difficult to replace. I'll have very high retention. As a consequence of that, I can spend less money serving you than it costs to acquire you. And that's the math, right? So why do we burn capital? Because we can spend more money in period one, because over the lifetime value of our relationship, you pay us back. Well, what if it's actually very easy to change your mind? To your point, Guy. What if every new upstart company is like, well, we integrate with this and that, and we have custom APIs, and now with AI, you have natural language APIs. So you don't even have to be technical to plug into some, MCP, model context protocol or whatever. If it's super easy to change your mind, then you'll change your mind more often, probably. And I think that's the biggest risk will be in the mid-market and SMB, where I think people will be switching vendors frequently. And I think the math of SaaS will falter. And it doesn't mean that we don't get to have companies, but it's another headwind, because the whole point of SaaS is The benefit of you never leaving is that I can spend a tremendous amount of money to get you in the first place. Well, if you do leave regularly, then I can't spend as much money to acquire you, which means I won't grow as fast. And that's why you see like this growth hitting a headwind, because all of these factors are conspiring to make the operating environment very difficult than the one that we grew up in. We grew up in a world, I'll never forget this, because it's just so funny, because, many people they think they understand business, and this is a separate talk track, but benchmarks are not understanding. Me saying, how fast does Guy run, therefore that is how fast I will run, is not an understanding of the human anatomy or how physiology works. It's somewhat useful, except when it's not. So there was this company that on their website, it was like, listen, we have an option calculator where you can calculate the value of your equity. All you have to do is take whatever your shares are, multiply it by the FMV, and we'll give you ARR, and it's just 10 times ARR is our value. And 10 times ARR, by the way, is very conservative. And it's just, it's funny because I think 10 times publicly traded SaaS businesses traded 6 to 8 times ARR. And 10 times ARR is not a thing, and it's not going to be a thing. And especially if people change them. The reason you get to be valued on revenue and not margin is because you have positive net revenue retention and you're growing very quickly. If you are not growing that quickly and you don't have 120% NRR, then you will not be valued on revenue, and you're certainly not going to get 10 times. And so I think that fundamental math-based reality is something that a lot of people are going to struggle with, which again is why the bar is higher.
We'll return to the episode in a moment. This podcast is brought to you by Ebsta. We are the only revenue intelligence platform with 3 brand guarantees. We guarantee to improve seller performance in the first 6 months. We guarantee to increase forecast accuracy to plus or minus 10% inside 6 months, and we guarantee to get you live within 30 days so you can influence this quarter's number. For more information, visit ebsta.com. Now, back to revenue insights.
I want to get on some of the other questions that have come through. One of them relates to what you've just talked about. So Alex Raymond asks, I'm curious why companies continue to overinvest in new business sales functions while skimping on the far more profitable investments in account management and customer success. The Ebsta data shows that 52% of net new revenue last year didn't come from new logos, it came from existing customers, and new business sales is less efficient than ever. So thank you for your question, Alex. Sam, any thoughts on why do we invest so much in sales? Is it just because they got louder voices than customer success, especially considering how much of our revenue is now so reliant on those account managers and customer success teams?
What do you think, Guy?
I think we're addicted to new logo revenue. I think we all think that new logo revenue is going to save the day. I think customer success and account managers aren't as loud and as demanding, perhaps, as the sales teams are. I think the biggest challenge here, this really comes down for me to the problem around CROs. I think a lot of CROs aren't actually CROs. They're really just VPs of sales. And the difference between a VP of sales that is really focused on how do I get that net new logo in and how do I make that deal as large as I possibly can versus a CRO that's looking at finding the right type of deals that maybe land is quite small but will continue to stay with us for a very long time and spend more money with us every year. And I think that strategic view on things is what will drive growth. And I think a lot of CROs don't get the opportunity to be strategic, and they get pulled far too quickly into kind of tactical deal creation and getting deals closed over the line.
I think yes, and everything you said, definitely I'm addicted to new logo growth, because churn is so much harder. You can say, oh, invest in customer success. Churn is the whole cannoli, the whole whatever, the whole big piece of food, the whole burrito, right? Because churn is, do you have the right people? Do they agree with how you've designed to solve the problem, and does it work? Well, changing that's fundamental. Plowing money into hiring salespeople is very easy. And I think there's a perception that retention is just a much, much harder nut to crack and takes much, much longer. And companies that hit a certain revenue growth trajectory, a certain revenue range, like my company, to be honest with you, churn catches up to you. The only way to even stay in place is to invest more in growth, even though you might be aware that as you're investing in growth, you're also investing in churn fundamentally. Now, you can try to do both. It's just that retention takes way longer to improve than growth is. And so you're looking at short-term versus long-term. Hopefully you're trying to do both. Hopefully you're really focused on doing both. But to your point, we're addicted to new logos because it's the easy button and because it's, instant gratification. And retention is a fundamental strategic problem to solve. And it often hits you at a point when you feel like the pain of solving it will take too long for where it might be that you're at 10 million ARR or 12 million or 15 million, and you might have to go back to 12 million to fix it. Show me the person that's comfortable doing that, and I'll show you an exceptional human, because that is very painful.
Yeah, we went through a similar challenge ourselves. A year or two ago, we would sell to anyone and everyone who came in, and we spent a lot of time over the last year really focusing on what our ICP is, and we found out our ICP. We can deliver value and revenue intelligence to a company with 5 sellers, but the impact we can have on outcomes, on growth, is relatively limited. But if you've got 50 or 100 sellers, my goodness, we can introduce consistency and get that growth really having a big impact. So the time and energy to sell to a small business versus a mid-market business for us wasn't actually that dissimilar. By focusing on the right ICP, those customers are much more likely to stay with us. We're delivering a whole lot more value, but it was painful. We had to make some conscious decisions, and there was a 3 or 4 month period where we weren't hitting new business goals because, it takes longer to build up the pipeline, and we were transitioning across. So I think the larger you are, the harder it is to turn that ship, but it's worth it. And I think if you can really unlock that value, if you can get the business a whole lot stickier, if you can solve that NRR number, then of course you're on trajectory to grow a whole lot faster. So, really good question here from Warren Zena as we talk about CROs. So with AI automating more and more of the sales process, do we think the traditional CRO role is heading for extinction, or is this a moment to finally become true business strategists?
I think it's the latter. I definitely think that. I think now is the time and we just brought on a CRO, and she's doing exactly what you're talking about, which is looking at the journey, looking at the business strategy, looking at pricing and packaging, and saying, where do we want to play? What are the levers for growth? No surprise, right? As the CRO, she says the number one lever for growth is retention, right? That's where we should be spending time, energy, and money. The next lever for growth is paid acquisition, and of course, pricing and packaging and things like that. But the point is, yeah, I think this is the moment when brute force no longer works. You need the business strategist. Again, what's the bottom line? The bottom line is everything we're talking about, Guy, is hard. It's not easy. The world is getting harder. And that's where, I think that's frankly where Pavilion comes into play. That's what our position needs to be in the world.
Without a doubt, my whole team has benefited from being members, and that the learning, in particular, the CRO school, is incredibly well received by not just my team, but we hear it a lot in the market as well. Really interestingly, Warren's actually started another course which is talking about actually preparing the CEO. Are they CRO ready? And I think we see all too often businesses think they want a CRO or think they need a CRO, but perhaps they're a little bit early for that. And really questioning whether the businesses themselves are ready for that CRO, I think is, while a difficult question to answer, actually is the cheapest way to do it if you can answer that question before you start hiring.
Sometimes, to your point, Guy, they think that hiring a CRO is hiring a sales savior. We're stuck. If I just find the right quote unquote CRO, we'll be saved. That never works. A CRO is investing in a function. Therefore, there needs to be enough flow. There needs to be enough of a machine that you can fix the machine. If there's no machine at all, you need to build the machine. So now you could say, well, hire the CRO to design the machine. I think you need to get your hands dirty. And I don't think you can outsource the development of the go-to-market engine completely. I think you can have a consultant, you can have a fractional, but I think if you want to hire a full-time operator, there needs to be something that they can work with, because you're investing in a discipline, not just a sales savior.
Do you think there's a line in the sand, Sam? Is it anything once you're about 10, 15, 20 million ARR, or you think it's unique for each business?
Probably unique, as that's a safer answer, but I think we're somewhere between 10 and 20 million. It feels like the right time for us to have a CRO. Could we have done it earlier? Probably a little earlier. Yeah. So, I think 5 to 10. I mean, I've written that the hardest part of the startup journey is 8 to 20. I think that is the hardest. That is where churn stops brute force and where you have to become sophisticated. And that's where the pain happens. That's when, you thought your model said you'd be at 30 million by now or 50 million, and lo and behold, you're not. And I think that's the hardest part of the journey. And that's probably where you need the adults in the room. As I think, you agree with me as well, because you've brought in some great people to help you at Ebsta.
I'm really blessed to have some incredible people that have joined the team over the last year to help us scale. So we've had a question from Gerard McNamara, who recently listened to your audiobook. And one concept which he wanted us to explore further is this common hour thinking. He sees it as transformational. So maybe you could explain to us what common hour thinking is.
Well, this is from my coach, but I really think it's from Henry David Thoreau from Walden. So let me relate it to something that's on my mind. You know what's on my mind, Guy? Mediocrity is on my mind. And it is the definition of common hour thinking. The thing that happens when you only have B players, or when you have too many B players, the first thing that happens is that the person that's a B plus looks like a AAA all-star, right? And that's so dangerous for that B plus person, because all of a sudden they probably don't have all the answers, but we hold them up as the person that everybody should admire. But what if that person doesn't really know what they're doing and they actually need a coach or a mentor? That is a function of mediocrity persisting through the organization. The other thing that happens with mediocrity, which is common hour thinking, is you begin to lower your standards. You think, I couldn't run 10 miles an hour. People can only run 5 miles an hour. Nobody could run a 4-minute mile. That's not a thing that's possible, or a 5-minute mile. And you start propagating that idea. And then everybody else, almost like a union, says, whoa, I better not work too hard. There's only so much I can do. And so common hour thinking is just the reality that most people, you get what you expect. And if you expect average, you will get average. And if you expect greatness, you will get greatness, and you're willing to put in the work. And common hour thinking is just this idea that most people do not want greatness for themselves, and so they don't manifest it, they don't envision it, and they don't set out to achieve it. But you don't have to be that person. You don't have to be. And you can change the results, and you can change the behavior. You can be Sam Altman or Mark Zuckerberg or Guy Rubin or Sam Jacobs or Walt Whitman. You can be somebody special, and you shouldn't feel ashamed about that fact.
It's taken us probably 18 months to move up a gear. I'm not saying we're all A stars here at this stage, but we certainly have moved up from one tier to the next. And while it was painful to begin with, I think the lessons learned from my side is all those people that I thought we couldn't do without. I wish they'd left earlier, right?
You were about to say, got rid of them. And you're like,
I didn't say that.
What if some of them are listening?
These valuable individuals that were great for us at the time where we were, actually, by making those painful decisions, we found ourselves in a place where we had the freedom to bring in people that were at the next level up. And it's been transformational for the business. And suddenly, I'm not the only one kind of leading the charge. I'm not the only one.
That is how you know. That is how you know, Guy. That's how you know. If you feel like you have to come up with every idea, that's how you know.
Someone said to me, actually at a Pavilion dinner the other day, said, if you go around your team in your mind and there's no one and any of them that you wouldn't hire instantly back again, then they shouldn't be in the team in the first place, which I thought was a really nice acid test. So Matt Harney has said, come up with a really interesting question. It's a bit of a tactical one here for CROs that are listening in. So what do you do if you're a CRO and you're given an unattainable revenue target? How do you push back on an unrealistic forecast? And how do you know if a forecast is realistic or not, especially when you're new to an organization?
Well, Matt, if you're not a member of Pavilion and you haven't taken CRO school, I'm worried for you. And you're trying to run a race with your foot amputated, but I'm running the race with steroids and all the gels I need. What's my point? The way that you answer this question, which we teach in CRO school, is through math. That's the point. We don't know if it's obtainable or unobtainable. We have to compare the unit economics to the available budget, and we have to look at how much did it cost us to acquire growth last year on a per dollar basis. Therefore, what is implied about the amount of money we need to invest to get the amount of growth that's being asked of us this year? Of course, we also need to factor in sales cycle, because if it's June or if it's February and we're complaining about our target, but we have 6-month sales cycles, it's way too late, because obviously the year really starts T minus whatever your sales cycle is. So if you have 90-day sales cycles, your 2026 begins October 1st. So the answer to that question lies in the P&L. That's why I say P&L fluency is like one of the core skills that every executive needs. You need to be able to learn to read financial statements. You need to understand like how the math of business works. And that will tell you if the growth targets are attainable or unobtainable. But your emotional reaction will not be helpful. And in fact, as CEOs, Guy and I can tell you that, we don't respond super well to emotional appeals. What we respond to is math-based and logical appeals. And, the thing I coach people on is this concept of inception. You have to make us believe it was our idea because we're not people that like to share ideas that well. And so what you have to say is, here's the numbers, here's the data, here's the relationships that I'm looking. You tell me what I'm missing. You tell me if I'm not seeing something. I'm operating in the real world. This is how gravity works. If you have a different gravity, holla at your boy. Let me know. But otherwise, we're gonna, let's work on physics. And I think that's the way to do it. Make it objective, make it computational and quantitative. That's the way to do it.
I love that. Yeah. And look, again, I mentioned earlier this shift that we made slightly more up market last year. And I pushed back a lot on the CRO we have, and they kept focused. They showed me the data. And even kind of 3 months in, when pipe was growing, but we weren't getting the new business in, and I kept pushing back, we stuck to the plan because it was data driven. And now we're seeing, we grew 25% in the last quarter. So, the numbers are coming in.
Let's go. That's great.
Right. So last question from the audience. I'm gonna raise a chap called Michael Ocean has raised a question to say he recently saw Jason Lemkin and Carl Norton talk about shifting to a 50-50 AI human sales org. At what point does an AI strategy shift from enablement to reduction? And how should CROs navigate that pivot without losing the culture and cohesion that made the team successful in the first place?
I don't know, Mr. Ocean. How the hell am I supposed to know? This is the point. The way to answer this question, go to the breakfast that Guy went to yesterday, get in a room through Pavilion with 5 to 10 other CROs and ask them, wow, the way to do it is with grace. The way to do it is with compassion, but also discipline and being tough and firm. You want to retain the SDR team. You want to retain your large organization. You're competing against people that are operating with more agility, with more speed. So I think you just have to be compassionate, but clear and direct. And I think you also have to be tinkering yourself. You have to, I know Kyle very well. We almost had his avatar that he loaded all of his information into on our podcast this week, where you can talk to it and it impersonates Kyle. He is somebody that's programming things all the time. I think you have to be somewhat technical so that you can be conversant in what's happening with AI. And then you just have to understand that, the world is difficult. Try to lead with compassion. And, to the point, like one of the ways that you can increase that quota, that percentage of people that deliver all the revenue is to have only great people. And that's going to be, that is a tough transition for a lot of people. So I have empathy for everybody out there.
I agree with everything you said. This time last year, there was the push was all around how do we get our B players to act more like A players? Now what I'm seeing is a completely different scenario where actually we just don't need the B players anymore. And what we need to do is just make our A players as productive as they possibly can be. And when we live in a world where half of deals close without a decision and then half of the balance are closing lost, we've got 3/4 of the deals that we're working on are not ending in a positive outcome. And we spend twice as much time on deals that close lost as we do with deals that close won. There is so much inefficiencies in our go-to-market motions, and all of this new generation of AI and technology is really there to help us to solve those challenges. And if you fast forward 3 years, we're not going to be as inefficient as we are today. Now, how we get from where we are to there is still an unknown answer. But as Sam was saying, how do we navigate that as leaders in this space? We work with other leaders. We spend time at summits. We spend time at these dinners and breakfasts. We engage in the learning because everyone is still breaking new ground at the moment, and in 3 years' time we'll be there, and then there'll be a period of stability where everything will work as it does for a period of time, right?
No, there will be no stability, Guy. I'm sorry, buddy.
You don't think we're going to see a big step change and then normality again? You think it's just going to keep getting faster and faster?
I'm a Ray Kurzweil stan, so the singularity is near. No, things are not going to get more stable ever. Things are going to get more and more chaotic, but that doesn't mean bad. There are opportunities. I was telling my partner this morning, I was a fractional CRO for one of the worst CEOs I can ever remember, and this company was an absolute disaster. And I couldn't believe that anybody gave this person money to run a company, and this was years and years ago. And lo and behold, this person was one of the earliest investors in Scale AI and just made 500 times their money in a couple of years, assuming this person wrote a $50,000 or $100,000 check. Just on that deal alone, they don't have to work anymore. So my point is, what do I know? I don't know anything, but I know that there's opportunity. There's opportunity. We have to be vigilant. We got to put the time in to find it.
We've got a few short, quick fire questions I'm going to throw at you, see if we can get through them in the time. So Sebastian has asked, what's your best advice on building community that stays active over time?
My best advice is to have tight criteria about who gets to join the community and clarify that you have standards and repeat those and reinforce those standards all the time.
Fantastic. Sabia's asking, where is AI playing a role in Pavilions and efficiency?
We're trying to put all of the information that's in the Knowledge Hub, in Slack, and all of our conversations into one interactive chatbot so that you get the answer that you need instantly, anytime.
Love that. Which 2 or 3 KPIs are your North Star today?
Well, my ultimate lagging indicator is membership ARR, but the North Stars, honestly, GPS is our member health score. It's called the Good Path Score. We use it to evaluate whether people are engaged or not. So that's probably the number one determinant of ARR because that leads to retention or not. And then, the number of people applying to join Pavilion, which is top of funnel. So we look at, the entire bow tie, basically.
Excellent. Great. What are 3 actionable steps go-to-market leaders can take today to move from hypergrowth to profitable, efficient growth? That came from Kevin.
Well, that's not a quick fire one.
Okay.
Part ways with your underperformers, develop a weekly develop P&L fluency across the organization so that you understand what efficiency means and what it looks like, and starve your unproductive channels and double down on your productive channels.
Love it. Well done. One more question from Graham. Why do we think that CROs are only lasting 18 months? Do we think they jump or are they pushed?
I think they're lasting shorter than 18 months. I took a look at the average days in role of the people that follow me on LinkedIn. I filtered by executives in sales and marketing, and on average, they've been in their job 15 months. So I think 18 months is over. I think it's getting shorter. I think the world is very hard. I think mostly the companies outgrow their ability to add value.
Sam, thank you so much for joining us today.
Thanks for having me.
We covered a lot of ground.
We sure did.
And if someone wants to get hold of you, wants to engage with you directly, or wants to find out more about Pavilion, where do they go?
They go to joinpavilion.com. We'd love to have you enroll. We're launching a new Pavilion Gold membership tier for operators from really 100 million in ARR all the way up to a couple billion. That is the elite, the best of the best. If you're interested in learning about that, you can email me, sam@joinpavilion.com. Otherwise, I'll hope to see you at GTM, our annual conference in Washington, D.C. on September 24th.
Yeah, I'm looking forward to that. We've got some brand new insights coming. We're launching our H1 updates to the B2B benchmark report at GTM in September. So looking forward to being there. And thank you so much for joining us, Sam.
Thanks for having me, Guy.
Thanks for listening to Revenue Insights from Ebsta. If you want to learn more from some of the brightest minds on how to predictably and efficiently grow revenue, then subscribe to our newsletter. We'll deliver actionable insights straight to your inbox. Go to ebsta.com/newsletter. See you soon.